Hi everyone, this is a quick post on today's Fed rate update and how it might affect yields and interest rates. Now, we're going to be doing a much more in-depth update on this in a couple of weeks after the RBNZ monetary policy statement on the 5th of April, and we'll talk a little bit about how that might influence the New Zealand property market then too. So sub if you're interested in that. I'll post a link below to the January update that we did if you want to see that. That'll give you a bit of an idea of what we'll talk about then. Right, so onto the US Fed. Now today's Federal Open Market Committee review meeting was one of the most watched in the last few years, as the failure of several US banks in just the last few weeks, followed by the near failure and fire sale of Credit Suisse in Switzerland, has thrown up considerable uncertainty over the stability of the global financial system and sort of fears of a 2008 style financial meltdown. Now, risks seem to have abated on that front over the last few days. Regulators have taken pretty substantive action to prevent banking fallout from becoming more sort of systematic. In the US, the Fed and the FDIC put in place emergency bank lending facilities to ensure that deposits can be fully funded for all banks if needed. Hopefully that's restored a good measure of faith in smaller regional banks in the US in particular. In Europe, Swiss banking regulators effectively mandated the sale of Credit Suisse to UBS. In both US and in Switzerland, shareholders and bondholders of the affected banks were largely wiped out, but bank customers have been protected. So while financial stocks have been fairly depressed, the broader stock market has seen some reasonable recovery since then. Now, it's worth saying at this point, just as an aside, that there's no indication of similar stresses in New Zealand or Australian banks. So there's no indication of loss of confidence that would spark a bank run. Banks here are far more tightly regulated in how they manage their balance sheets, and therefore their exposure to interest rate risk is more carefully managed. Banks in New Zealand and Australia are highly profitable and well managed, unlike Credit Suisse was. So there's no indication that we're going to see similar US-style meltdowns here. But we have seen some pretty big action in bond markets. US treasuries in particular have seen volatility at their highest level since the global financial crisis, as we can see in the BOA Move Index, which tracks volatility in bonds. And in fact, US two-year treasuries saw their largest one-day decline in yield since 1987. So bond markets are supposed to be relatively safe, predictable, probably a little bit boring, at least compared to equities markets. So movements like this are pretty rare, and usually they signal pretty significant market stress. And really that's why the Fed decision today was so closely watched. It's the first Fed meeting in a long time where the outcome wasn't already fairly well expected, basically. The US Fed, as per our own RBNZ or the RBA in Australia or the ECB or other central banks, they've steadily been raising rates since early 2022 in an effort to combat inflation that's been running at multi-decade highs. So, but as we can see, events over the past few weeks, that rapid pace of heightening chances is really heightening the chances of hidden risks in the broader financial system being exposed and causing wider damage. So the balancing act for the Fed was always going to be a tough one. Does it keep raising in the face of clearly emerging dangers, or does it back off and risk inflation continuing to run out of control? In the end, the Fed's kind of stuck to script with an increase of 25 basis points. So the Fed chair, Jerome Powell, he provided some commentary on the banking issues in his speech in the press conference. The view of the committee at this stage is that risks are largely contained and isolated to a small handful of uniquely exposed banks, and the backstop protection the Fed and the FDIC have put in place. With that, they expect that no significant fallout is going to affect other areas of the financial system at this stage. There has been a bit of a shift in tone since their last meeting, though. Their statements are no longer referring to ongoing increases in interest rates, and their outlook's only anticipating one further increase, which would imply a terminal rate of sort of low fives, 5.1, 5.2%. Now, this would put the Fed squarely at the end of their tightening cycle, which is actually earlier than markets have been pricing in as of February this year. So what does this mean? And is this going to make your mortgage more or less expensive? Well, all the action in the last few weeks has significantly lowered market yield. So if we look at US two-year treasuries, yields are down from around 5.1% in early March to slightly below 4% today. It's the same in New Zealand, with New Zealand government two-year yields dropping by more than 0.5% in the same sort of time frame. So that's a significant drop, and New Zealand interest rate swaps have seen some big falls as a result. Now, what are swap rates? Simplistically, you can think of interest rate swaps as an indication of bank costs. We might go into this in more detail in a future video, but basically when a bank borrows money to lend to mortgage holders, the swap rate is going to set a big portion of the bank's cost to lend and the rate that they charge you on your mortgage. If we look at 2-year swaps, we can see a significant notable decline in rates from early March onwards. Now, they've been pushed higher in March by inflation data concerns and expectations of central banks getting firmer on inflation, but they've really come crashing down in the last few weeks as those yields have fallen in the last couple of weeks. Now, we've seen some minor movements in fixed mortgage bank rates on offer in the last few days. A couple of the main banks here in New Zealand have tweaked their fixed rates sort of around 20 basis points, 0.2% or so lower, kind of across the curve. But I do think it's important to keep this drop in context. So if we look at the same 2-year swap rate and what that's done since late 2021, it is clear that this is a relatively minor movement in the bigger picture. So while it does feel like we might be nearing the end game for the current tightening cycle, it's clear that there's still a lot of unanswered questions. So inflation's still the overarching question of the day. Labour markets are still tight and keeping pressure on services inflation. Real rates are likely to keep getting tighter in the short term, really driven by a combination of central bank action and probably tightening of credit as banks start to hunker down after these recent failures. And it's clear that economic headwinds are building. So overall, this does feel like this cycle is nearing an end, but I guess at the end of the day, only time will tell. So hopefully that gives everyone a bit of an update on things. Thanks again for watching. As I mentioned, we will be doing a more in-depth property market update after the RBNZ OCR update on the 5th of April. So keep an eye out for that. And bye for now.